This is Al Brooks, and this is my price action trading course. This module has to do with trading strong bull channels. Remember the market cycle. The market is either trending or it's in a trading range. And when it's trending, it starts with a breakout, which is a strong trend, and then it transitions into a channel where the market has pullbacks, and then the channel eventually transitions into a trading range. The trading range can break out in either direction, and then the cycle begins all over again with that breakout. Trends have spikes initially and then channels. The spike is the breakout phase, and it's a strong bull trend. And the market is very one-sided. For example, if we're talking about a bull trend, and the bulls are totally in control of the market. Eventually the market starts to have pullbacks and a channel develops, and the market then is in a weak bull trend, certainly weak compared to the breakout phase. There's some two-sided trading, but it's still a bull trend, so the bulls are still stronger than the bears. But the bears are occasionally in control, and that's what creates an occasional bear bar or an occasional pullback. That's evidence that the bears are in control for those brief periods. How do you know that a channel is present? Whenever you see signs of two-sided trading, the market's in a channel. Channels are always contained between two lines, but sometimes it may be difficult to understand what the two lines are. So sometimes it's not always easy to see what lines the market is using to create the channel. But if you, with experience, and if you look hard enough, you'll usually be able to find the two most likely lines. The types of channels. A channel is a type of trend, and it's part of a trend, and it's sloped up in a bull, it's sloped down in a bear. A trading range is a channel. It's an entirely horizontal channel. Triangles and wedges are channels. Triangles are mostly sideways. Wedges are either diagonal and sloped up or down. But they're channels because anytime the market can be contained between two lines, it's in a channel. Channels can be very strong, almost as strong as breakouts, or they can be very weak, almost as weak as trading ranges. In a strong channel, there's minimum two-sided trading, and the market's behaving much more like a spike. When you're in a strong channel, only trade in the direction of the trend, and we're talking about bull trends here, so you only want to buy. When it's in a weak channel, and they're very prominent two-sided trading, big swings up and down, you should trade it like a trading range. Buy low, sell high, and scalp. Since it's a bull channel, make sure to buy low to take the longs. Taking the sells at the top of the channel is less important. When you're looking at the market and you cannot decide whether a channel is strong or weak, assume that it is strong and only look to buy. When you're looking at the market and you cannot decide if it's still in the spike phase or if it has transitioned into the channel phase, assume that it's in the breakout phase, in other words, strong, and only look to buy. When channels look like this, very tight, very small pullbacks, they're spikes on higher time frame charts. This is the weekly S&P, the weekly spider. When channels look like this, only look to buy. Don't worry about taking shorts. You won't make money on the shorts because the sell-offs won't drop far enough to make a profit. This is too one-sided and no significant bear strength. Here's the daily spider. When a channel looks like this with very broad swings, very deep pullbacks, you certainly should buy because it's a bull trend, but you can also short as well. When a channel is very tight, it's still a weak trend compared to a breakout, but it can be almost as strong as a breakout. And when it is very strong, you trade it like a breakout and only trade in the direction of the trend. And if you look at a higher time frame chart, that very tight, strong channel is simply a spike on the higher time frame chart. Here we have a gap up and then a couple strong bull trend bars. So the spike is the gap plus the 2 bull trend bars. And then you can draw 2 lines that contain the price action. So this is a channel. But look how small the pullbacks are, 1 or 2 bars, and they don't even fall below the prior bar. So this is an extremely strong bull channel. It's a very tight channel. However, it's relatively weak compared to the spike phase. But it's so strong that you should only trade it like a spike, like a breakout, and only look to buy. Again, channels can sometimes be almost as strong as spikes. The channel can be very tight with very small pullbacks and very little two-sided trading, maybe an occasional bear bar. It's still weak compared to a breakout phase, but it's still strong enough so that you should only look to buy. Treat it just like a spike, just like a breakout. Whenever the market's in a strong bull channel, you should look to swing just as you would in any strong bull trend, like a breakout phase. Swinging is better than scalping, and like all channels, it follows a spike. The spike may be small, it may be simply a single bull trend bar, it may be large, it doesn't matter. As long as you see a channel, you know you're in a trend, and you know it's a channel, and if the channel is very tight, try to swing and treat it more like a breakout. When a channel is very tight, if it is a very strong bull channel, it is a spike on a higher time frame, and if you look at the higher time frame chart, you'd only be looking to buy, and you would be expecting the market to go higher. So on the 5-minute chart, you should also only look to buy. So here's an example. 5-minute chart on the left, same chart on the right, 15-minute chart. We have a gap up on the open, the pink rectangle. Here's that same gap on the 15-minute chart on the right. The green box on the right, it's a wedge-shaped bull channel, but it's very tight and the pullbacks are very small. They don't even fall below the low of the prior bar. This is what that green box looks like on the right. So on the left, it's a 5-minute channel. On the right, it's a series of consecutive bull trend bars on the 15-minute chart, close above the high of the prior bar, so there are gaps all the way up. Every close is above the high of the prior bar, so there's a gap between the close and the high of the prior bar. So this is an extremely strong bull spike, and you should only be buying, and buying for any reason. And the same is true with the 5-minute chart. So what are the signs of a strong bull breakout, a spike? Big bull trend bars, consecutive strong bull trend bars, small tails, in other words, bull bars closing on their highs, and no significant selling pressure. No bear bars, no reversals. And the context has to be supportive of higher prices. You don't want it to be a race to the top of a trading range. And how do you diagnose a spike? Well, you just look for big bull bodies, closes near their highs, small tails. Here's a gap, that's part of a spike. We have a series of 3 consecutive bull bars, and there are gaps. The high of the close of this bar is above that high. The close of this bar above that high. Close of this bar above the high. Close of this bar above the high. So the market is gapping up on a lot of the bars. Very little overlap between adjacent bars, and a series of consecutive bull trend bars. So these are very strong bull breakouts. So a gap spike here, a bull spike here, and another bull spike here. These 2 last spikes are within the context of a wedge channel. And what are the signs of a bull channel? In contrast to a breakout, you have pullbacks. They might be small if the channel is strong. There might be an occasional bear bar, some overlap between adjacent bars, some areas of sideways trading, and a lot of the bars will start to develop tails on top of the bars. So the the bar is going up and up and up, and then into the close of the bar, it sells off. So that means the bulls did not control the bar into the close, and that the bears are getting stronger. Also, if the bull channel is made of smaller bars, that's a sign that the bull is not as strong. When the market is in a strong bull channel, you should trade it like a breakout, a spike, a strong bull trend, and try to swing at least part of the position. When you are scalping, use a tight stop and go for a reward that's at least as big as your risk, and more experienced traders will scale in as the market goes against them. You always need to diagnose as early as you can. So here we have a big gap up, a two-legged move that did not even reach the moving average, a 2-bar reversal, and then 3 strong bull bars closing near their highs. We went sideways here for 5 bars, so maybe we're entering a channel. These bars are getting smaller body, tail on top, so we're probably in a channel phase. But the channel is tight. The distance between the trend line below and the trend channel line above is very small. And the pullbacks are very, very small. It's not even pulling back. So you know that this is a strong bull trend. Well, it's actually a weak bull trend because it's a channel, but it's a very strong channel, and it probably is a spike on a higher time frame chart. So you have to get long. You can't look at this and say, well, 1 push up, 2 pushes up, top of the trend channel line, a wedge top. There's simply not enough selling pressure, and there is too much buying pressure, too many big bull bars, too many gaps in the bull bars, close above the high of the prior bar, close above the high of the prior bar. You cannot be looking to sell. You can only look to buy. So you can buy for any reason. You can buy the high 2 over here. You can buy closes. So you buy for any reason, and you certainly don't sell. So how do you get long, and where is your stop? Is it time to buy yet? Whenever you look at the market and you're starting to feel agitated, desperately hoping for a pullback, you know the trend is strong. And when that's the case, if you're not long, just buy at the market. Buy at least a small position at the market and use a stop below the bottom of the bull spike. You just determine how far away your protective stop is and try to go for a risk at least as big, and depending on how many ticks you're risking, that determines your position size. If you are having a hard time determining the exact position size, don't worry about being exact. Just instantaneously trade half size or quarter size, and buy right now this minute and trust your stop. How can you buy? Lots of ways to buy. Just as with any strong trend, if you're in a strong channel, same thing. You buy at the market. You buy at the close of bull bars. You buy at the close of bear bars. So if the market is in a bull channel and you have a bear bar, you buy its close. You buy above the high of the prior bar. You buy below the prior bar, betting that any reversal attempt will fail. You press bets and you buy breakouts above swing highs. So the market goes up, you have a pullback, place a buy stop 1 tick above that high and buy again as the trend resumes and goes above the prior high. If you have bull flags, pullbacks, you buy breakouts of the bull flags. If you pull back to the moving average or a trend line, any other kind of support, you buy at support. And you look to take profits at resistance, such as at new highs or reversals down from new highs. Okay, going into the details of that chart, buy at the market, buy at the close of strong bull bars or strong bear trend bars, it doesn't matter. Buy above and below the prior bar. So here's an example. You just buy at the market. The trend's going up, you know it's going up. Buy at the market and buy small. Put a stop below this ledge, or a stop below this bull bar, or a stop below this bar. Whichever stop you choose, make sure to trade small enough so that your risk is not too big. We're getting a series of strong bull bars. Buy at the close of the strong bull bar. We have a little pullback. Buy above the high of this bull pullback, betting on higher up. We have a bear close. That's an attempt to reverse the market. Buy the close of the bear, because the attempt will probably fail. The market's trying to reverse here. Context is not good. Prior pullbacks are very small. This will probably fail. Place a limit order to buy at its low and get filled as soon as the market moves 1 tick below its low. You don't have to take all of these, but make sure to take at least one of these. You don't want to sit without any position at all, hoping for a pullback that never comes and then missing a trend like this. Okay, isn't it sometimes better to wait? Well, it always feels like the market's forcing you to buy too high at the top of a channel that just keeps growing up. And it feels that way because it is. Traders are always afraid that a big pullback could come anytime. Maybe we're having a buy climax. Well, you are having a buy climax, but that doesn't mean the market will reverse. A lot of times it'll have a series of buy climaxes, and when the trend is strong, you have to get long. The setups, they never quite look good enough. You know it's a bull trend, and therefore you believe there's a 60% chance that the market will go higher, yet it never feels 60% certain. You still have to take the trades. You know, you look at it and you say you think it's going higher. That means you're 60% certain. Trade it like a 60% trade. Figure out where your stop is. Take a position size that's appropriate for that stop. Place a profit target equal to the same number of ticks as you have in your stop, and then exit when the market gets up to your target. If your actual risk is less, you can go for a smaller target. You'll never be more than 60% certain, but don't be paralyzed by the 40% chance that you'll lose. You are going to lose. You're going to lose 40% of the time, even if you're a good trader. But 60%, that's as good as it gets. And if you're going to trade for a living, you have to trade. Okay, so setups never look quite good enough. You know, you can buy closes. You know it's going up. You look at this, you say, well, I don't know, even if it pulls back down here, it's still going up. Well, if it pulls back down here, is it still going up? Probably not. And therefore, somewhere below this bar, you'd say, well, it's probably not going up. So that's where you put your stop. Below here, below this entry bar, below this breakout bar, below this ledge. You know, pick whichever one you want. The tighter your stop, the more likely you'll get stopped out. But when you look at this, you know that the one thing you know is if it gets below this low, the low of the day, it probably will not go up further. So worst case scenario is you put your stop here, calculate how many points you have to risk, and then trade small enough so that you can rely on the stop. If the market just quickly goes up 2 or 3 points and you're able to take 2 or 3 points out, take at least half off. If it's going up slowly, you might take all of it off. So if the trend is weaker, you might take more of it off. Okay, so now we got another trend bar, and now we got another breakout and a bunch of dojis. So we're entering into a tight trading range. 3 pushes up. We have a push, and then here's the second push, and then the third push. These 2 bars. So is it a wedge top, and should we expect a correction back down here or here? The channel up is so tight that I would never look to short. We have 3 pushes down, 1 push down here, second push here, third push here. So it's a triangle and a bull trend. Could very well be a bull flag. I think it's reasonable to buy above that high, or you could wait to see if we get a pullback to the moving average. We got a bull reversal bar for the triangle buy setup, which is good. So you could buy 1 tick above the high of this bull bar. Bear is trying to reverse, and you know, the market ticked 1 tick below the high of that bear reversal bar. To me, I think you can scalp out of your longs, but way too much buying pressure, and the channel is way too tight, and the pullbacks have been way too small to be thinking about taking any shorts. Another bull bar, so probably going higher. Okay, now we've entered a tight trading range. So the market has transitioned. It was in a strong bull trend, and now it's transitioning into a trading range. Once you think the market is always in long, in other words, once you see the breakout and you say, yeah, I think this is going higher and I'm worried that I'm flat, buy at least a small position. You can see the modules on breakouts and trading strong trends to get more information about different ways to enter. Again, I mentioned earlier, you can press bets. You can buy breakouts above prior highs. So if the market is up here and it pulls back, you can buy as the pullback resumes up. But if you miss that, you can always buy on a stop at 1 tick above the prior high. Also buy any small pullback, any bull flag. This is an example of pressing your bets. We have a swing high, market pulled back. If you don't buy above this bear bar or this bull bar, you can place a buy stop 1 tick above the prior high to get long. You can buy at the market as a pullback is forming. We have this bear reversal bar, but the context is bad. This entry bar is bad, the follow through is bad, You can simply buy at the market, betting that the top is not going to succeed. You can buy a breakout of a bull flag. Here we have a triangle, 3 pushes down, 1, 2, 3, and we have a bull signal bar. Buy one tick above the high of the bull bar, betting that the pullback will end and the trend will resume. You should also look to buy at support, and you should also consider taking profits at new highs and at resistance. What's an example of support? A trend line is a good example of support. So traders will buy at the trend line or just a tick or so below. They'll also buy at the moving average. Despite the strong bear bar, they'll bet that the breakout attempt by the bears will fail, just like all the prior breakout attempts by the bears failed. And where do you put your protective stops when you're swinging? You put them below the most recent higher low. It's as long as the market continues to make higher lows and higher highs, the market's in a bull trend and your premise is still good. If it falls below the most recent higher low, that's a problem. That means it's no longer in a strong bull trend and your premise is wrong. And if your premise is wrong, you get out. So that's a good location for a stop. When you're scalping, you're not going to allow pullbacks. You might allow a tick or two pullback, but for the most part, you do not allow pullbacks. If you have a strong trend bar or up or a strong trend bar down, either one, get out below the low of the strong trend bar. So let's say you bought this close, this green box, right? You could put your stop below the low of the bar because it's a breakout bar. You could also put it below the low of the most recent higher low. That is a better stop, but it's a wider stop, and wider stop means higher probability of success, but when you lose more ticks. Both are valid approaches. Let's say you bought here at the close, or for any reason, above the high of this outside up bar, above the high of this bear reversal bar after it triggered in shorts. You can use a tight protective stop below the low of the bear breakout bar, or you can use a wider stop below the low of the most recent higher low. Same thing, the wider the stop, the more likely you'll have a profitable trade, the less likely you'll get stopped out. But when you do get stopped out, you'll lose a little bit more money. And that's okay, both ways are okay. The market transitioned into a trading range, so you stop trading it like a bull trend. It's now a trading range. You trade it like a trading range. You buy low, you sell high, and you scalp. I don't feel that it's as necessary to worry a lot about taking the shorts because we're still in a bull trend, but I definitely would try to take the longs. Okay, IOI here, bull bar here, breakout pullback here, small breakout pullback here, outside up here, maybe buying above that bear bar. I don't know. Okay, strong bull trend, only look to buy. You can say, well, Al, this is a trading range, and this is a buy vacuum test of the top of the trading range, and here's a low 1, and here's a low 2. I'm going to short. I would not. To me, we had a bear trend, a break above the bear trend line, a test of the low, and a reversal up. This is a lower low, major trend reversal. We have a low, a lower low, and a lower low. We have a high and a higher high. This is an expanding triangle also. So that's a pretty reliable buy setup. And we have a strong bull micro channel with 7 bars up, and then a breakout with 3 very strong bull bars. To me, you have a terrible signal bar for the bears, especially given the strength of these 3 bull bars. So probably buyers below. And then we have a low 2 short here, but again after a bull bar, and we've only had 2 small bull bars in the past 10 or 15 bars. That's not enough selling pressure to justify a short, especially when you have a bull bar for your signal bar for the short. So low 1s and low 2s are only in bear trends, not bull trends, or they're in trading ranges. And this appears to me to be a major trend reversal and not a trading range. So this is not a low 1 and this is not a low 2, and I would not be taking these shorts. Strong trend, especially after these bars, I think it's better to only look to buy. And that's the end of my module on trading strong bull channels.